Good morning, everybody, and welcome to what is our 7th webinar and final in this series. And while this is the final presentation that we're giving to you all today in this series, we are working out how we can continue to bring you content and updates in the coming weeks and months. And so after this webinar, please keep an eye out on your emails, and we will look to continue to engage with you and bring you items of interest. So please watch out for that. In relation to the webinar today, we have had a slight change in terms of its content and presentation. BDO have just recently been engaged on a large new matter, and some of the presenters that we had planned to bring you today are actually on client sites this morning, and they are very busy. So it was always my intention, though, to bring you a snapshot of our view of the finance market and environment. And while the vast majority of you are bankers or financiers, we wanted to bring you our view on what has happened over the last 12 months and how our clients are seeing the finance world. And hopefully some of that is relevant to you in terms of how you deal with your clients. And so we'll commence with the presentation. I am the presenter, and normally we would have a couple of BDO people, but for today it is just me, and so apologies if you get sick of my voice. You're welcome to just mute me, and then you can look at the presentation later, but hopefully I'll keep this relatively concise and then open it up for questions, and you're welcome to throw anything that you'd like at me, and I'll attempt to answer those either towards the end or if there's something relevant that I'm able to answer during the presentation, I'm happy to do so. In terms of what we'll cover today, just briefly, there is 4 main sections that I wanted to cover off, and then there's a little bit of depth to some of those, but it's basically the economic impacts that we've seen, how there's been a bit of a shift in finance availability and activity, and some of that has been taken up by non-bank lenders. We are going to touch a little bit on enforcement in terms of banks or financiers taking action. That's not my main area of focus, but again, I do some work with clients who are facing some financial distress, and so I wanted to share with you what I've seen and how that may inform you as to your decisions where it's relevant. Obviously, BDO do work for a number of financiers, and while enforcement generally has been fairly subdued for obvious reasons in the last 12 months, there have been some changes there as well. And then we look a little bit at what would be favourable outcomes for financiers and their clients I have written in a COVID-19 world. I guess it's potentially in a post-COVID-19 world, although I suspect we'll still see some lingering effects. So we'll jump into it. The first section is the economic impacts affecting businesses, and I'll cover this fairly briefly. But on a global scale, we've seen the emergence of most economies from the very worst of the COVID-19 depressed activity levels. Most economies are opening back up, although as we've seen, there's second and third waves and other ongoing issues. But certainly we are in a much better place than where we were about 12 months ago. And I don't know about you all, but it was about this week in March a year ago when we were locking down. And I think, in fact, it was the 16th of March that my own children had their first day at home. And that's when there was a lot of uncertainty and panic, and a lot of businesses literally were just shutting their doors, at least temporarily. Certainly what's been in the news headlines recently has been a bit of a political and economic reset in the USA with a new administration, and in the last week we've seen this new relief package being unveiled, and it is a very large amount of money, 1.9 trillion, I believe, and that in itself is going to not only affect the economy in the USA, but have far-reaching effects around the world. Certainly the vaccine development and the rollout has provided a lot of confidence and certainty, and even in markets where they have had very little in terms of formal lockdowns, the availability of the vaccine has given both consumers and business owners, I think, a lot more confidence to go forward. Certainly, there's a lot of government stimulus still in many economies, and the monetary policy of most governments around the world is still very accommodating, our own included. And certainly, from what I've been able to garner in terms of the international press, but also what we're hearing from our clients, both here domestically, but also our clients who are in international markets, is that there is certainly a return to a risk-on mindset. They're certainly looking now at throwing off the shackles of 2020 and the impacts of COVID, and are looking to find new ways to do business and to grow. That's not to say, of course, there aren't businesses or industries that are facing ongoing challenges, and we will touch on that. But certainly across the board, there is a more confident mindset of business owners and individuals. In terms of the Australian story, again, not telling you anything here probably that you don't already know, but clearly the activity as a whole is back to levels pretty close to pre-pandemic levels. But of course, that's patchy. There are some areas that have done well through COVID-19 and in fact have continued to grow and grow very strongly. Some of those are mentioned there: durable goods, anything to do with household staples, anybody who is able to manufacture locally and supply the domestic market. Obviously, there are lots of areas that are doing it very hard. Any service-based industries that rely on people movements or people coming together, anything in the entertainment and tourism industry, even services attached to those, such as hotels and the like. Property markets have rebounded very strongly in general, although again there's patchiness there, and I'll talk more about property slightly later. But I think it would be a surprise to all of us if we had taken ourselves back 3 or 6 months and said, we expected the residential property market to be, booming back into, double-digit growth rates. I think we would have thought that that was impossible. But here we are in March, and that's what's occurring. Household saving rates are still high. There is a lot of cash in people's bank accounts. A number of banks have come out and identified that their own balance sheets are strong, partly because of that. So notwithstanding interest rates are low, people they have that cash in their bank account, and that may be there as a buffer in case when this government stimulus rolls off, that they may need it. But certainly it is available to spend, and certainly with interest rates low, that has certainly got people considering taking out loans, and certainly again the property market has been the beneficiary of that. The federal government has continued to evolve its thinking in how it provides support, and while we've had multiple versions of relief packages aimed directly at businesses and consumers, there's now a more tourism-focused package. Obviously, not everybody is quite happy with the way that has been rolled out, and that will probably need some tweaks. But certainly the government is trying to identify those areas that most need its support. There are a number of other areas where the government has provided support, some of that is now coming off, and the most visible one is perhaps the JobKeeper scheme winding down this month, and that remains to be seen how much of an impact that will have. The China trade relations has been an ongoing challenge for some producers, certainly some in the agri space and others who had a high reliance on China. That being said, in general, again, most industries have found other markets. Many of the commodity prices remain quite good, partly because they are finding other markets. And at this stage, Australia seems to be weathering that relatively okay. Not to say that there wouldn't be more pain down the track if that was to be exacerbated. So in general, there is certainly a new confidence emerging, and even though I wrote this perhaps a week ago, I'd say even stronger confidence now. It seems every day that goes by, there is more people talking about expansion and growth and new opportunities, as opposed to those concerned for the immediate future. In terms of some of the key impacts for our clients that we've seen, and I by no means am an expert on these areas, and in fact there'll be others that I won't mention here, but these are some that I have spoken with clients about, and again, probably isn't a shock to you, but anything that has a labour intensive focus in terms of businesses or industries, they have had challenges. Agriculture's deficit of seasonal workers. There are many producers out there that cannot find workers who are willing or able perhaps to move to pick fruit or vegetables. Some of those industries are having to find alternative methods, or in fact, I think what we will find is that food and veggie prices might rise in the coming months. There are lots of industries that have gone further to try and avoid issues with any potential social distancing issues. They've tried to either minimise or manage their labour force. Some have actively sought to reduce their reliance on it by finding other ways, and that will be a challenge for some people in some industries, where they may find that the job opportunities are either less available or not there at all. In terms of imports, there are still a lot of our clients who are struggling to efficiently land goods in Australia. The worldwide supply chains are still challenged. You will have read perhaps in the press that there has been a lot of cost and delays in getting items through the ports. There's still a lot of cost in getting containers and getting space on ships, and that is proving to be very difficult. We've had some people who have put in orders to buy major pieces of equipment and got finance approved for that, only to find that with the delays, their approvals elapse because 90 days passes before the goods are even landing in Australia, because the suppliers literally can't get it to Australia. It's all of a sudden they're having to go back to financiers and refresh those approvals and try and work through that. Interestingly, yes, any business that has been able to source locally and continue to provide its goods or services based on local supply has done very well, and in fact that has dovetailed in very nicely with the sort of holiday at home mantra, or the support local type mantra that's gone out, and lots of local businesses who source locally have been very well supported by the consumers. From a finance perspective, again, you will know this, but most banks still have access to very cheap funding. The RBA continues to provide liquidity facilities to banks. Obviously, deposit funding has been high, albeit I know the net interest margins have been squeezed because there is a lower bound on interest rates at zero, so that has made some of the return metrics a little more challenging. But certainly, I don't believe there's any financiers out there who have been challenged from a balance sheet perspective. There was a time during COVID that financiers were cautious and in some cases very cautious. And in reality, I think what we saw for a period of perhaps 6 months, there are a number of banks, including some majors, which were not really open for new business at all. While they were willing to talk, most of their focus was on supporting existing clients. And that's great, but it did mean that if you were looking for new finance, it was difficult to come by. Perhaps as a general statement, as sort of September and October came around, and I think we realised that the worst of the panic through the COVID period had passed, and in fact there was some semblance of normality returning. All of a sudden banks did decide that, yeah, perhaps they could continue to lend a little bit more freely. And certainly since I think everybody came back from their end of year holidays, we have found that every financier has been ringing on the phone or knocking on doors saying, we're open for business, we're ready to go. There is an interesting sort of story around, I guess, what I've called rebalancing. Clearly, as deferrals, as in interest or principal deferrals declined, and as COVID-affected businesses got back into paying their loans, we've also seen the government come out and provide their government, federal government guarantees to back SME loans, and we're now up to, I think, version 3 of that, which starts on the 1st of April. Although, interestingly, that has only been embraced by some banks. While I think most financiers, where possible, have signed up to the scheme, there have really been chalk and cheese differences between financiers that were really happy to continue to lend and provide that as another option, whereas there are other financiers who almost encourage their clients or their borrowers not to even look at it, whether it was because they internally felt that that was a sign that borrowers were continuing to struggle and they didn't want to flag that internally, which I don't know that that necessarily is the case, but there obviously was also the case of a major financier who effectively would not allow people to apply unless they had still some evidence of COVID related impacts in terms of their turnover. So while I think the government's intention was to make additional finance more freely available to any business that was capable of meeting the bank's normal risk appetite, I think what we found was that there was really not a lot of incentive internally for some banks to offer that. And I think the only reason that I've heard as to why that's the case is that in some scenarios, banks were comfortable to lend to a business in its own right, and there are some strings attached to that government-backed facility, and the banks had a priority to not utilise that facility and would prefer those borrowers to just go through the normal channels. Rightly or wrongly, I think what we found is that there hasn't been as much of a take-up, anywhere near as much, and in fact, on one figure, and I haven't been able to verify it, there was a comment that only 2 billion out of 40 billion available had been utilised, and that was a couple of weeks ago. I think that was for version 2 of the SME business support scheme. So take that at face value. You'll have your own views on whether or not you've had sufficient take-up of those sorts of facilities. But I think in general, finance has been available, which is great. It wasn't probably the case back in the depths of the COVID environment, but certainly is now. I'll just quickly cover off on what we've seen in property, and in a lot of areas it's been very positive, certainly residential and industrial and more general commercial. Office has clearly been negative. Anything CBD based has actually been probably challenged, and that includes hotels in the CBD, which probably cater a lot for business travellers. It also includes perhaps high density accommodation. But again, that resi high density accommodation has probably been supported somewhat by the fact that residential housing generally has been very strong. Retail is again a story of two different types of retail. You've got those that were focused on staples, your neighbourhood shopping centres, your small shopping strips that have done relatively well, certainly those in metro areas, but not necessarily in the CBD. But certainly anything that was discretionary, and to that extent, it's often the larger shopping centres where there's a lot of either luxury or there's clothing, anything that could be conveniently bought online. Those have struggled, and we know that values have come off there, probably not because of forced sales, but just because valuers have been nervous about it. Certainly regional locations have been generally very positive. A lot of people deciding they can now work and live elsewhere as opposed to in a capital city. But yeah, some parts of the major cities have been negatively affected. Agriculture's been very good generally, and that's been a sort of confluence of events, including a very good season generally across Australia in terms of rainfall, where it's needed, when it's needed, relatively good commodity prices in most areas. There's one or two exceptions, but in general, that has been very good for the agri community. Again, anything exposed significantly to export, depending on the product, has had some challenges. Manufacturing, again, has been generally strong. Lots of businesses that we've dealt with have experienced upticks in demand, and again, that's where Australian consumers are looking to buy locally. And again, there are certain manufacturers that have done incredibly well. Anything that allowed people to holiday here locally, and motorcycle retailers or manufacturers, caravans, anything to do with the beach, surfing, fishing, jet skis, all of those sort of local holiday type items, bicycles even, motorbikes, I said motorbikes, anything to do with activities here locally has been incredibly well supported. And in fact, if you're relying on something imported, you can walk into some shops and not find a stock at all. Services, clearly difficulties in many areas, especially where you've had services attached to businesses that can't operate in the same way in relation to the COVID lockdown. So anything that relied on large groups of people coming together, they've been impacted. There are some exceptions. There's been businesses that have been involved in logistics or involved in home deliveries. Obviously, a lot of that is shifting with the change in buying habits. So a little bit onto the sort of changing face of the finance environment, and I guess I just touch on where I've seen what I'll call traditional banks go through this time period. APRA continues to obviously look for having the banks be strong, and they continue to, I think, robustly police that. Banks, though, are well capitalised, well funded. They probably have a more cautious risk appetite than other lenders, and that may be presumably, obviously, from the perspective that they have APRA looking over their shoulder, and as ADIs they do have to be somewhat more cautious. And interestingly, though, they continue to be very strong supporters of anything property backed. I think that will become more of a topic of discussion as we see things like the residential market continue to boom, but also, as I'll touch on in a later slide, when it comes to enforcement, anything property backed continues to give traditional banks a lot of comfort, and there's less risk in that, and I'll explain what I mean by that. Certainly, anything property backed continues to have a very low loss given default, and the banks feel very comfortable with it, and so that sort of lending has been very strong, possibly because of the way risk-weighted assets work in terms of bank calculations for APRA's purposes, it probably does skew the availability of funding and the price a little bit towards property-backed lending. And again, that's, I think, what's created opportunities for non-bank lenders. The impact of the Banking Code of Practice, I think, perhaps has been underreported. I think if you're in the SME space and you are you're not an owner of property, you don't have the benefit of a property to secure any lending, your ability to secure lending from a traditional bank in that sort of $1 to $3 million or perhaps $1 to $5 million space has been no easier, dare I say it, under the Banking Code of Practice, and in fact it may be harder. While certainly there are elements of the lending that have benefited borrowers, the clearer documentation and where there are no or few covenants, that has certainly made the banking facilities a lot more straightforward. But I think the availability of it and the ability to get the loan in the first place has probably suffered. So we have neobanks, new financiers coming into the market, and I've been amazed at the number of new entrants that have popped up in the last 12 months. Almost all of them privately funded, so these are not listed entities. These are people who have the backing of some very strong balance sheets. Interestingly, or ironically, some of them are actually funded with wholesale lines from the traditional or major banks. And I've sort of split them into what I call sort of two different categories. One is what I'd say is an algorithmic approach to lending. These are new banks who have decided that their way of identifying good lending is to use big data effectively, with the availability of transactions through bank statements and other methods to categorize and assess it. We've seen a number of lenders who have automated processes to really take a lot of the manual work out of assessment and have been willing and able to provide funding very quickly. A computer can analyse and assess this in minutes typically. And while that used to be perhaps just the domain of, those sort of personal loan lenders, for loans of up to $5,000, we're now seeing that approach being spread out across the small business space, and there are lots of lenders now who will provide lending to small businesses once they've been able to do an assessment of their trading patterns and their bank statements. And the sophistication in some of that analysis does amaze me, because they can even get to the point of identifying the typical speed at which suppliers pay their invoices, the regularity of that, when there are cash flow squeezes in a monthly or quarterly cycle, how they can best map out a working capital solution that suits the lender, suits the borrower. Now, at this stage, those non-bank lenders continue to be more expensive, and that presumably reflects their funding profile. But I think over time, we will see them become a more and more competitive offer out there in the market. There are, of course, lots of niche lending areas where the traditional approach to lending continues to be good bankers or lenders who are assessing deals, and they've continued to focus on asset lending and working capital or cash flow requirements. There are obviously also lenders who are happy to do property-backed lending, but they struggle to compete with the banks on price, unless it's perhaps in the development space where their gearing profile and their risk appetite is much stronger than the banks. So that's been interesting in terms of their involvement, and we're finding a lot more of our clients now have facilities from a non-bank lender, and it may not be it may not be to the exclusion of a traditional bank. In fact, we're often finding clients coming to us with structures where they've got a non-bank lender providing some of their finance requirements and a major bank providing, perhaps some property lending or some core lending requirements. That may become more of an issue down the track if and when there are challenges or issues and potentially enforcement, and we'll come to that shortly. So there is a bit of this contradiction, as I've just touched on. Low, interest rates are very low. There's lots of funding available through traditional banks. Banks generally have been amazingly supportive and have been praised, I think, for their approach through the COVID period to give businesses some space, give them some support, obviously give them a window to get back on their feet, and they continue to do that very well. And I think we've avoided any wholesale carnage in the business lending space or even in the residential lending space, because banks have been very supportive. They obviously also have the benefit of this federal government-backed lending, which they can roll out. And businesses themselves have had all of the other stimulus measures made available to them from the government through tax and other initiatives. But as I mentioned, I don't think banks necessarily, in some areas, are the cornerstone of that finance solution for clients anymore. We're seeing a lot of customers who are separating their payments processing from their transactional facilities. There are a lot of new digital arrangements that can be put in place where payment processing is occurring outside of the normal bank EFTPOS system or the credit card system. Certainly the move to online sales and other things is probably only exacerbating that. And certainly there are now lots of businesses out there that don't really want to accept cash. They're happy for you to pay in multiple ways, and it doesn't necessarily flow through what would be a traditional bank arrangement. We're also seeing this separation of finance from those transactional facilities. So again, perhaps historically a business would have all of its facilities, including its loans and transactional facilities and payment processing all through a bank. We're now seeing sort of this multi-strand approach where you can have an FX provider separate from your bank or your lender, who might be a different lender for the working capital as opposed to the core finance requirements. Banks are still going to be the main provider of transactional facilities, but a lot of these other things are starting to splinter away. And that provides some challenges to financiers when you've got to identify and recognise where the liabilities might sit and where the challenges might be if there is financial distress down the track. Interestingly, and I did just want to put in this final point that, as I mentioned, there are a lot of these non-bank lenders who are accessing and utilising this data. And from my history and background as a banker, I kind of always thought that, well, you might be able to identify the data, but you can't really get to know the character of the individual. And character, always was a significant part of the lending decision. However, interestingly now, these non-bank financiers are also, they believe, able to identify some elements of what they would call character in the data that they see. And that comes from potentially multiple sources, but they think that they can identify businesses that pay on time, that pay well, compared to those that perhaps have to enter into payment arrangements, those who have to squeeze their suppliers because their cash flow is lumpy. A lot of these things, these non-bank lenders are starting to identify that they think they can identify who the better borrowers are just from their data. Now, it won't completely remove the need to get to know your customer, but it is interesting that they feel more and more confident that there's valuable information in that data. So in terms of enforcement, where there are challenges, where clients have been unable to repay their loans, it's an impact that we haven't seen a lot of, because there has clearly not been a high level of insolvencies, certainly not driven by the financiers. There clearly have been some, but we've had an incredibly low level of insolvencies for the last year. I know a number of people were looking at potential points in time when they thought things would change. 1st of January, when there was this new small business insolvency regime that has been sort of made available to the insolvency practitioners of the land. We really didn't see much change there. More people are identifying perhaps the end of March in terms of another potential trigger point if the JobKeeper comes to an end and businesses can't stay afloat. But at this point, there's nothing that has been coming that we see as a tidal wave, and certainly not from a bank's perspective. There are, I think, some reasons why we may not see any real change in the bank's approach to enforcement, notwithstanding the financial situation out there in the economy. And part of this, I think, probably started some years ago when APRA continued to push the banks to continue to adhere to their policies on lending, to avoid exceptions to policy when lending, and to try and stay within the bounds of where the risk appetite was. Now, banks, I think, have done that very well from what I see. They have been very diligent at just maintaining lending in areas that they want to lend to, and not straying too far outside of that. But I think what that has perhaps done is shifted the typical bank lending book down the risk curve. And what I mean by that is down to the lower risk end. While banks have not chased some of the excesses that was apparent pre-GFC, I think what that means is that the actual bank books continue to be incredibly low risk and clean. And I think we've seen that by virtue of the very low bad debt expenses that all of the banks continue to report, notwithstanding the challenges that a lot of their customers have had in the last year. Interestingly, even that I think, and this is only anecdotal, but if you exclude anything fraud related or anything else where there's some major falling out between a client or a customer and a bank, we've actually not seen a lot of times where banks have just applied the default rate, to a customer, the moment that they have had their facilities expire or the moment that they've missed a payment. It almost seems universally accepted that bankers will sit down with clients and work with them, and the default rate may be used, but it's pretty rare. And as a result, it's hard to sometimes judge between the difference between what might be considered a good borrower and a bad borrower, because often the interest rate doesn't tell the story at all. We certainly perhaps see a little bit more into what clients are like and what they do. We're engaged by a lot of clients, and yeah, those who are doing the right thing and trying very hard, notwithstanding they may have financial challenges or financial distress because of where their business is at. There's not often much of a difference between where the bank takes their facilities to in terms of price compared to a borrower who is doing the bare minimum, not particularly responsive. And I think part of that has occurred because banks haven't wanted to take this enforcement action, certainly not in the last year, certainly not since the Royal Commission, perhaps, and outside of a few, perhaps notable scenarios, there's not been many actions taken by banks to truly recover their funds through a formal enforcement scenario. And to that extent, I suspect, and please tell me if I'm wrong, but I suspect that banks are not always well rewarded for taking additional risk, especially at the back end where there have been defaults or where there has been financial distress and clients are asking banks to provide them more time, to put in place new measures or to do various things. If the interest rates haven't changed, clearly in that scenario, then clearly with a risk grade that has deteriorated, banks are not going to be probably being as well rewarded as they should be for continuing to support those clients. Now, I'm a client advocate. Most of my work, I guess, is done on behalf of clients. They have been the beneficiary of that, and I guess I can't complain about that. But I think that is one of the challenges that banks have seen, in that they're challenged by not taking enforcement action, but they're also not. You'll never meet your return on equity requirements. You know, if a bank facility's risk grade has deteriorated past what would be in a normal pass grade credit. Certainly the cost of business failure is greater now, and what I mean by that is there's a whole lot of reputational risk and other stuff that goes along with taking enforcement action. It's the challenges of working through AFCA complaints and all of the hassle that goes on with you know, having to ensure that everybody in the bank is comfortable if you're going to go down that path. The cost is certainly greater, I think, from all of those sort of perhaps non-monetary perspectives, but also the return is not there. The default rates are not being applied. The interest rates are not rising commensurate with the risk grade deterioration. And interestingly, I still have people come to me almost on a weekly basis who, on the one hand, complain that banks aren't lending enough or not lending them enough. That's probably more the point, that they don't get the loan that they want. But then, you know, I get somebody else who, you know, is aggrieved that the bank, you know, doesn't want to lend them, you know, money because they've stuffed up or something, and now the bank, you know, would prefer it back. So, you know, they want more money out there, and then, you know, all of a sudden they don't want, you know, the risk of the bank then deciding that they don't want to lend anymore. So what would be favourable outcomes? And I've got a few questions on 2 slides here for you. These insolvency reforms, and it's not my area of expertise, but, you know, are they achieving the outcomes that we'd all hope for creditors? And what I mean by that is not just unsecured creditors, but also the secured creditors. Is it actually achieving a better outcome? Certainly we don't know, because I don't think they've been tested very much. I suspect they aren't necessarily going to achieve better outcomes, but that's just an opinion. Are business owners and directors in a better position now? Maybe. They certainly have a few more tools at their disposal, but I'm not sure that that necessarily means that they've had more capacity to work with their banks and have support when they want to grow and get access to more funding, even in a riskier position. Only you can answer this question as to whether or not you think the recovery processes are working better or worse. Certainly it's different now than what it was perhaps 10 years ago in the GFC. And how do you measure success? Is it that you know, your balance sheet remains clean and you have a very low bad debt level? Is it that you have a few complaints from borrowers through AFCA or anything else? Is it that you recovered 100% of your loan? Is it that you actually got a decent return for the risk that you were taking by going through that process? I think some of those are the questions that remain to be answered. And lastly, in terms of sort of recycling this capital, taking it from one area of the economy that is now not as productive, and I guess through COVID, we know that there are areas such as tourism that there isn't going to be the ability to finance as many operators or to the same extent as there previously was. How do you take that from that area of the economy and put it into more productive areas? How do you respectfully remove your funding in areas where they're in distress? Where you have a borrower who does service interest but can't amortise their debt, or perhaps has no real chance to amortise it over any reasonable future period, it's pretty hard to suggest an enforcement activity there when they're meeting their interest. but you potentially have loans that are stuck in this sort of zombie state where, yes, they're limping by, partly because interest rates are at generational lows, but they're not really getting ahead, and the bank probably feels that it's unable to press for much more. Can price be a motivator again? Are banks going to return to applying default rates and increasing the interest rate where there is additional risk? Will that be a better tool for recycling capital and having those borrowers decide that they have to find a resolution rather than just limp along indefinitely? And I guess to that point, is there a possibility that workout bankers focus on the return to the bank in terms of an ROE rather than other metrics such as reducing the balance sheet of, poor risk-rated loans? That may be a better driver, perhaps. But I have no answers to those questions. They're just ones that I wanted to pose for you to consider. And I'd be interested if you have any questions or any comments you'd like to make. I'm happy to open it up to questions. Please let us know. Just give you another few moments if there are questions. Perhaps no questions today. Maybe there are no answers to those questions. I don't know. I do hope that you found this webinar interesting. I hope you have had something that you can take away from that. We are going to come back to you all with what we can bring to you in the coming weeks and months, so please look out for that. In the meantime, we're obviously more than happy to touch base with you if you'd like to discuss anything, and you're more than welcome to have a copy of this presentation after the webinar if you'd like. Thank you for your time. Enjoy your morning, and we'll talk to you soon.